Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business, what it does, how it makes money, and what makes it competitively distinct.
Berkshire Hathaway traces its roots to a Massachusetts textile mill founded in 1839. Warren Buffett took control in 1965 and spent the next 6 decades transforming it into the world's most admired holding company.
The genius of the model starts with insurance float. Berkshire collects premiums up front and invests that capital before claims are ever paid. With over $165 billion in float, it's essentially permanent, low-cost leverage.
When Berkshire underwrites profitably, a combined ratio below 100, they're actually being paid to hold that capital. The insurance engine is self-funding and compounds value simultaneously, a rare structural advantage.
Beyond insurance, Berkshire owns BNSF, one of the two dominant U.S. Class I railroads. It hauls coal, grain, intermodal containers, and consumer goods across 33,000 route miles of Western rail network.
Berkshire Hathaway Energy rounds out the infrastructure layer, electric utilities and natural gas pipelines serving customers across multiple states with stable, regulated returns and growing renewable generation capacity.
Then there's the manufacturing and services cluster. Dozens of businesses from precision cast parts to See's Candies all run autonomously with minimal interference from the lean headquarters operation in Omaha.
That decentralized model is a durable competitive moat. Berkshire attracts founder-led companies that want to sell but preserve their culture. No private equity pressure, no short-term restructuring mandates, no layoffs.
The public equity portfolio adds a fourth leg, over $300 billion in publicly traded stocks. The concentration in a handful of high-conviction names reflects decades of patient, conviction-driven capital allocation.
On the competitive radar, Berkshire scores near the top on economic moat and balance sheet strength. Over $160 billion in cash and treasury bills gives it firepower that most institutions simply cannot match.
The scale of Berkshire's businesses means revenue growth is measured rather than explosive. The trade-off is resilience. Diversified cash flows across insurance, rails, utilities, and manufacturing cushion any single downturn.
Peers like JP Morgan and BlackRock occupy adjacent capital markets territory, but nothing fully replicates the Berkshire model. Insurance float combined with operating businesses and a long-duration public equity portfolio.
Warren Buffett has run Berkshire since 1965, over 6 decades of continuous leadership. Greg Abel is the designated successor, and the transition has been managed deliberately to preserve culture and capital discipline.
Berkshire's subsidiaries reach all 50 U.S. states and operate in 26 countries, reflecting the remarkable breadth of industries it spans, from auto insurance and aerospace components to ice cream and mobile homes.
The recurring theme across every subsidiary is the owner-operator mentality. Berkshire gives managers the autonomy to run their businesses, and in exchange demands disciplined capital returns and honest financial reporting.
That's the company chapter for Berkshire Hathaway. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
Berkshire Hathaway just released Q1 2026 results, and the most important number isn't the EPS. It's the $162 billion sitting in treasury bills. Buffett's annual meeting in Omaha this weekend made one thing clear. The greatest capital allocator in history is waiting for his pitch. This is Charged Alpha. Let's break it down.
Berkshire Hathaway is a $1 trillion diversified conglomerate, the largest financial holding company in the United States by market capitalization. It owns GEICO, BNSF Railroad, Berkshire Hathaway Energy, and dozens of operating subsidiaries, plus a $300 billion public portfolio anchored by a massive Apple stake. The business model is built on insurance float compounding.
Q1 2026 operating earnings came in strong. Berkshire focuses investors on operating EPS, stripping out investment gains and losses that Buffett himself calls meaningless for quarter-to-quarter analysis. Insurance underwriting delivered a meaningful profit, BNSF rail volumes held steady, and BHE utilities contributed regulated cash flows. The overall operating picture reflects a resilient multi-engine conglomerate.
Walking the income statement, total revenue for Q1 is estimated near $93 billion, up approximately 6% year over year. That growth reflects premium increases at GEICO, modest volume gains at BNSF, and BHE-regulated tariff escalations. Gross margin runs near 36% on a blended basis across the diversified business mix, while operating margin lands around 13%, consistent with the prior year quarter.
The margin story is really the insurance story. GEICO's combined ratio improved materially in 2024 and held discipline through Q1 2026. When Berkshire underwrites at a sub-100 combined ratio, meaning it makes an underwriting profit, it is being paid to hold the float. That is an extraordinary structural advantage. Every dollar of float earned is essentially free investment capital deployed into Berkshire's equity and treasury portfolio.
Cash flow is where Berkshire is exceptional. Operating cash flow over the trailing 12 months exceeds $38 billion, a figure that few companies in any industry can match. Free cash flow lands near $32 billion. That cash generation is what fueled the record $162 billion cash and treasury bill position. Berkshire's balance sheet is a fortress, near zero net debt when offset against the cash hoard, and total equity exceeding $585 billion.
Capital returns in Q1 were measured. Berkshire repurchased approximately $2.6 billion in BRK-B shares, below the pace of prior peak buyback quarters. That deceleration is a signal. Buffett sees current prices near his estimate of intrinsic value. The company pays no dividend, a deliberate choice. Buffett's position is that Berkshire can compound retained earnings more effectively than shareholders can with dividend income.
The annual meeting in Omaha delivered a key update on succession. Greg Abel, the CEO designate, led several Q&A segments alongside Buffett. The transition framework remains on track. Abel has operational control of all non-insurance businesses. Ajit Jain continues to oversee insurance. Buffett's public endorsement of Abel's capital allocation judgment was the most significant non-financial signal from the weekend.
Wall Street's view on Berkshire is structurally cautious by nature. Consensus sits at 3 buy ratings, 9 holds, and 1 sell. The average price target of $510 implies roughly 8% upside from the current $473 price. Analysts who rate it hold are not bearish. They acknowledge the quality, but argue that at the current price, better near-term returns exist elsewhere. The bulls are making a 20-year argument, not a 12-month one.
Valuation: Berkshire trades at approximately 20 times trailing operating earnings and 20.5 times forward 2026 estimates. Price to book is 1.7. EV to EBITDA is 14 times. For a $1 trillion conglomerate with fortress balance sheet, these multiples are not cheap, but they have historically been the entry point for the long-term compounder thesis. Berkshire's intrinsic value compounds with book value. At 1.7 times book, the implied premium to book is modest by historical standards.
The bull case on Berkshire rests on 3 pillars. First, the insurance float machine. Over $165 billion in float. Capital Berkshire holds on behalf of insurance customers compounds at roughly 4% annually with disciplined underwriting. This float is essentially permanent and grows as Berkshire's insurance operations expand. No other investor has access to this structural lever.
Second bull pillar, the $162 billion cash position, is optionality, not a failure of deployment. In every major market dislocation since Berkshire's founding, Buffett has deployed capital at extraordinary prices: the 2008 financial crisis, the 2020 pandemic. The bigger the cash pile, the bigger the bet when the right pitch arrives. That waiting game has historically generated some of Berkshire's highest returning investments.
Third bull pillar, the decentralized compounding model. Berkshire's 50-plus operating subsidiaries run autonomously with minimal corporate overhead. Profitable subsidiaries send cash to Omaha. Omaha redeploys it across the capital structure. That frictionless capital recycling, from See's Candies to BNSF to Treasury bills to Apple, has compounded book value at roughly 20% annually for 60 years. No private equity firm or conglomerate has replicated it.
The bear case opens with the law of large numbers. Berkshire is now over $1 trillion in market capitalization. Deploying $40 or $50 billion meaningfully moves the needle, but finding $40 billion opportunities with Berkshire's quality bar is structurally harder than it was in 1980. The mathematical ceiling on outperformance compounds with size. Bulls who extrapolate 60-year CAGR forward are likely too optimistic.
Second bear, Apple concentration. Apple represents approximately 28% of Berkshire's public equity portfolio. Buffett has been a seller over several quarters, but Apple remains a dominant position. If Apple underperforms meaningfully, regulatory pressure, iPhone saturation, AI hardware competition, the portfolio effect on Berkshire's reported book value is material. A 10% Apple decline clips Berkshire's reported equity by approximately $8 to $10 billion.
Bottom line on Berkshire Hathaway, this is the safest way to own one of the most sophisticated capital allocation machines ever built. Q1 2026 confirms the model works. Insurance underwriting is disciplined, operating subsidiaries generate reliable cash, and the balance sheet has never been stronger. For long-term investors, holding BRK-B is holding a diversified, managed portfolio with a proven compounder at the helm. Financial data sourced from Financial Modeling Prep. Charged alpha is for educational purposes only and does not constitute investment advice. Always consult a qualified financial advisor before making investment decisions.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing.